Right now, let's talk more about inflation and that Fed decision. Senior economics reporter Steve Leisman joins us right now with the outlook from the CNBC Fed Survey. And Steve, I guess I have to preface all of this with asking when this survey was run, because it seems like things are changing at such a rapid clip right now.
Yeah, we do the best we can on that, Becky. This was data gathered Thursday, Friday, and part of Saturday. We collated it on Sunday, and here we are on Tuesday. So as quick as we possibly can. And let me give you the impression from it, which is that it's really hard to understate the difficulty of gaming out the outlook or the task for the Fed, with some problems, of course, of its own making, facing high inflation, a second wave of higher prices coming, and the uncertainty of war. The Fed forecast to bring the funds rate to 1.4% this year, 2% in 2023. But all of this happening while the chance of recession in the U.S. over the next year up 10 points from our last survey to 33%. And it's gauged at 50% now for Europe. Recession, though, worth pointing out, not the base case for respondents. While the average forecast is for 4 hikes this year, the risk is skewed towards more hikes. 48% of the 33 respondents, they actually forecast 5 to 7 hikes. So you can see it's tilted there. The Fed will do more than just hike. It's seen reducing its balance sheet this year by more than $500 billion and almost $1 trillion next year. Total reduction is estimated to be $2.7 trillion over about 3 years. All of this comes amid forecasts for greater inflation and less growth. The Consumer Price Index seen peaking at 8.5%, and that is in March or April, I believe, gradually declining to finish the year at 5.2%. That's up a full percentage point from the February survey. CPI in 2023, well, that goes down to a tamer 3.3, still above the Fed's target. Almost every respondent stressed that amid the fog and uncertainty of war, confidence in their surveys was low, risks tilted to the downside. For a discussion here, about half believe the Fed may ultimately have to boost the Fed's rate above the 2.5 neutral rate to slow the economy to control inflation. That's the big concern, Becky, I think, out there.
Yeah, Steve, just kind of looking through those numbers, the one that jumps out the most to me, I don't know, as you mentioned, they don't know how much faith to put in this at this point because things are changing so rapidly. Maybe the most concerning one would be odds of recession, 33% in the United States, 50% in Europe. That's got to be the number that people maybe are thinking about the most, because if that's the case, it's going to be pretty difficult for the Fed to raise 7 times. Like, what was it, 48%? You said 5 to 7 times?
Yeah, I mean, that's a very good point. I will point out that Joe Livornia, ex of the Trump administration, now at Natixis, he thinks the Fed won't have to raise it all because he believes that the economy is very close to recession. He penciled in very, very low economic numbers. And the other thing, and I think you're right, Becky, to hone in on those 2 numbers, because recession in Europe, if that 50% probability happens, it creates probably more drag on the U.S., so that raises it would lower the growth forecast and raise the probability of recession. Just by way of context, though, as you know, any given survey we do, there's a 20 to 25% chance of recession in there. 19% is low, 18% is low. So 33% is definitely high and elevated, but not that far off the norm.